Hello, I'm David Hardesty, and in this lecture we explore the U.S. domestic tax rules requiring income tax withholding on non-business income. In a previous lecture we examined non-business income that is subject to tax and therefore subject to withholding. This lecture is in two parts, and this is part one. The withholding provisions, which are provided primarily in Regulation 1.1441 to 1.144110, are voluminous and detailed. No purpose is served from attempting to become an expert in these regulations, so we will not try to do so. However, a working knowledge of the withholding is necessary to avoid some of the more costly errors in this area of taxation. Accordingly, the objectives of this lecture are to understand the following: the types of income subject to withholding, the persons from whom tax must be withheld, persons required to withhold tax, withholding on payments to intermediaries, the presumptions regarding payees and types of income, the various forms and certifications that impact withholding, and income tax withholding rates. There are four main withholding provisions, two of which will be covered in this lecture and two of which will be covered in other lectures. Section 1441, withholding of tax on non-resident aliens. This provision applies to non-business income subject to 30% withholding or to withholding at a lesser rate when a tax treaty applies. This provision is covered in this lecture. Section 1442, withholding of tax on foreign corporations. This provision applies to non-business income subject to 30% withholding or to withholding at a lesser rate when a treaty applies. And this provision is also covered in this lecture. Section 1445, withholding on dispositions of U.S. real property interests. This withholding provision will be covered in the lecture on U.S. real property interests. Section 1446, withholding on a foreign partner's share of effectively connected income. Because of time constraints, we will talk only briefly about this withholding requirement. Just know, for now, that it does exist. So first let us discuss briefly the income subject to withholding. In general, the income subject to withholding that we will be discussing in this lecture is limited to non-business income that is taxable in the United States when received by a non-resident alien, foreign corporation, or other taxable entity. As in the lecture on taxation of non-business income, our focus in this lecture will be on withholding as it relates to taxable interest, dividends, rents, royalties, and other FEDAP income. For a discussion of taxable non-business income, see the previous lecture on the taxation of non-business income. Now let's talk a bit about withholding rates. The general rate for withholding on non-business income is 30%. It's the 30% rate. However, if a tax treaty applies, the tax rate may be reduced by treaties. If the tax rate is reduced by a treaty, then the withholding rate is likewise reduced. Later in this lecture, we will discuss how to claim a lower rate of withholding under a treaty. There are other statutory and tax and withholding rates that apply to specific types of income. We will discuss these briefly later in this lecture. Now let us turn to the mechanics of withholding. First, to whom do the withholding rules apply? Withholding is generally required only when a taxable payment is made to a payee who is a foreign person. For this purpose, a foreign person is a non-resident alien individual. We covered the classification of individuals as non-resident aliens in a separate lecture. A taxable foreign entity. These are foreign corporations, trusts, and estates. We covered the classification of entities as foreign in a separate lecture. A foreign partner, that is a non-resident alien or a foreign taxable entity. Governments of foreign countries. And certain foreign branches of U.S. companies. Here's a question. If tax has been withheld from a foreign person's U.S. source income, does the foreign person still have to file a U.S. tax return? In general, a foreign person does not need to file a U.S. income tax return if the person's tax liability is fully satisfied by withholding. However, the person does need to file if the person is engaged in a U.S. trade or business. In addition, the person needs to file if the person had only non-business income and not all of the U.S. tax owed on that income was withheld. Here's an example of the general requirement to withhold. Domestic Co. is a U.S. corporation that borrows money from Foreign Corp., a Country X corporation engaged in commercial banking. Foreign Corp loans $1 million to Domestic Co., which Domestic Co. repays with $50,000 of interest a year later. As discussed in the lecture on taxation of non-business income, interest paid on a loan made by a foreign bank in the ordinary course of business is non-business income subject to tax in the United States at 30%. As such, it is also subject to withholding. This example is continued on the next slide. Domestic Co. withholds the tax and remits the tax to the U.S. Treasury. It reports both the interest, income, and withholding on Form 1042 and Form 1042-S. These forms are discussed later in this lecture. Foreign Corp's U.S. tax liability has been fully satisfied with this withholding, and that corporation need not file a U.S. tax return. To determine if withholding is required, we ordinarily need to know who the beneficial owner of the income is if that person is different from the payee. A withholding agent must withhold on any payment subject to withholding made to a payee that is a foreign person, unless, however, it can reliably associate the payment with documentation upon which it can rely to treat the payment as made to a beneficial owner that is a U.S. person. That is, withholding is presumed to be required if payment is made to a foreign payee unless the documentation shows that the beneficial owner is a U.S. person. In addition, unless the withholding agent has documentation upon which it can rely that shows that the beneficial owner is entitled to a reduced rate of withholding. And even if the payee is a U.S. person, withholding is required if the payee is the agent of a foreign person. So, if withholding is ultimately based on the beneficial owner, who is the beneficial owner? The beneficial owner is the person who is the owner of the income for tax purposes and who beneficially owns that income. A person is treated as the owner of income if that person must report the income as gross income in its tax return under U.S. law. A payee is not a beneficial owner to the extent that the person is receiving a payment as a nominee, agent, or custodian, or to the extent that the person is a conduit whose participation in a transaction is disregarded. Likewise, foreign partnerships, foreign simple trusts, and foreign grantor trusts are not beneficial owners since all of the income is merely passed through. Here's an example of withholding where the beneficial owner of a payment is different from the payee. Domestico makes a dividend payment to Lipton, a Country X citizen and resident. No tax treaty is involved. Unless Lipton can provide documentation to Domestico providing that the beneficial owner of the payment is a U.S. person or is a foreign person entitled to a lower rate of withholding, then Domestico must withhold at 30%. Assume that Lipton is a nominee for Adams, a UK citizen and resident, who is the beneficial owner of the payment. Adams prepares Form W8BEN, indicating that she is the beneficial owner of the payment. This example is continued on the next slide. Adams uses the form to indicate that she is entitled to the benefits of the U.S.-UK tax treaty and that dividends are taxed at only 15%. Lipton provides Domestico with a W8IMY, indicating that Lipton is a nominee and includes with that form Adams' Form W8BEN. And based on this documentation, Domestico withholds tax at 15% on the payment and reports the withholding to the IRS as being made on behalf of Adams. We need to know who's required to withhold tax. This is the person which is known as the withholding agent. A withholding agent is any person that has the control, receipt, custody, disposal, or payment of an item of income of a foreign person that is subject to withholding. It is the person who last had custody of the payment prior to its being made to the payee. A withholding agent can be either a U.S. person or a foreign person. Let us look at an example of a withholding agent. USB is a U.S. corporation and securities broker doing business in the United States. USB pays U.S.-sourced dividends to Foreign Corp, a Country X corporation that has a brokerage account with USB. No tax treaty applies, and the dividends are subject to withholding at a rate of 30%. USB is probably a withholding agent because it is the person that has control over the payments to Foreign Corp. An important responsibility of the withholding agent is determining the proper withholding rate. Once a withholding agent identifies a payee as a foreign person who is potentially subject to withholding, the withholding agent must determine the proper rate of withholding. This requirement includes ascertaining whether the payee is entitled to a reduced withholding rate. If the withholding agent withholds at a rate lower than the required rate, then the withholding agent is potentially subject to tax, interest, and penalties on the amount of the underwithholding. From whom is tax withheld? As discussed earlier, withholding is required only if the payee is a foreign person, but beneficial ownership of a payment can change the requirement to withhold or not. If, however, withholding is required, then the tax is withheld from the payee. The payee is the person to whom the payment is made. Tax is withheld from the payment to the payee even if the person to whom the payment is made is not the beneficial owner of the payment. However, special rules and exceptions exist with respect to withholding on payments made to intermediaries, nominees, and physically transparent entities, which include partnerships and some trusts. These rules will be discussed in the next set of slides. If a payment is made to a qualified intermediary, or QI, then the payer is often relieved of the responsibility to withhold tax. When a payer makes a payment to a qualified intermediary, which has assumed primary withholding responsibility, then the payer does not need to withhold tax. For this purpose, a qualified intermediary is a party that has entered into an agreement with the IRS to assume full or partial responsibility for withholding, depositing, and reporting on payments to foreign persons. A QI can include a foreign financial institution or clearing organization, a foreign branch of a U.S. financial institution or clearing organization, a foreign corporation, or any other person that is acceptable to the IRS. The QI may be either a U.S. or foreign person. The QI will furnish a qualified intermediary withholding certificate to the person otherwise required to withhold tax. Form W-8-IMY is often used for this purpose. If the QI has assumed full withholding, depositing, and reporting responsibilities, then the certificate is in lieu of other documentation with respect to the person for whom the QI receives the payment. If the QI has not accepted full responsibility, then it must still provide documentation to the withholding agent. Special rules apply if the qualified intermediary has not assumed full withholding and reporting responsibilities. Here's an example of a payment to a qualified intermediary. Foreign Corp is a Country X financial institution that has entered into a qualified intermediary withholding agreement with the IRS. Under the agreement, Foreign Corp is subject to the withholding and reporting provisions applicable to withholding agents and payers, except to the extent provided under the agreement. Under the agreement, Foreign Corp assumes full withholding and reporting requirements. This example is continued on the next slide. A U.S. withholding agent makes a payment to Foreign Corp on behalf of various foreign persons who have accounts with Foreign Corp. Foreign Corp presents the withholding agent with a QI certificate on Form W-8 IMY, and the withholding agent is relieved of withholding. Foreign Corp will withhold and deposit the tax and will file the necessary reports with the IRS. Foreign Corp need not provide the withholding agent with information about the beneficial owners of the payment. If a payment is made to a non-qualified intermediary or NQI, then the withholding agent is not relieved of the responsibility to withhold tax. A non-qualified intermediary, NQI, is an intermediary that receives payments on behalf of beneficial owners but has not entered into a withholding agreement with the IRS to assume primary withholding and reporting responsibilities. A payment to an NQI does not relieve the payer of its withholding responsibilities. That is, the payer is the withholding agent and must withhold tax on the payments to the NQI. The NQI provides the payer with information regarding the beneficial owners of the payments, and the payer, as withholding agent, withholds and reports accordingly. What happens if the NQI does not provide documentation from beneficial owners? In this case, the withholding agent must withhold tax based on certain assumptions discussed later in this lecture. Here's an example of a payment to a non-qualified intermediary. Domestico, a withholding agent, makes a payment of U.S. source income to a non-qualified intermediary. The beneficial owners of the payments are non-resident aliens who are citizens and residents of country X. The NQI provides a valid intermediary withholding certificate on Form W-8 IMY to Domestico. Attached to the form are Forms W-8 BEN for each of the beneficiaries. Domestico withholds tax based on the information provided in the W-8 forms, just as if payments were made directly to those beneficial owners. Special withholding rules apply for fiscally transparent entities, that is, flow-through entities, such as partnerships and simple trusts. An entity is considered to be fiscally transparent to the extent that the laws of a jurisdiction require the interest holder in the entity to separately take into account, on a current basis, the interest holder's share of income, whether or not distributed to the interest holder, and the character and source of the income to the interest holder are determined as if the income was realized directly from the source that paid it to the entity. For purposes of withholding, the payees of a payment made to a fiscally transparent entity are deemed to be the interest holders of the entity. The most common examples of fiscally transparent entities are partnerships and simple trusts, where partners and beneficiaries report all of the income recognized at the entity level on their personal tax returns, regardless of whether the income is distributed. Here's an example of a fiscally transparent entity. Foreign trust is a country X trust. Under the trust instrument, all income earned by the trust is required to be distributed to its beneficiaries, and under the laws of country X, the beneficiaries must recognize the income as it is earned by the trust, regardless of when it is actually distributed. Foreign trust is considered fiscally transparent. Here is an example of an entity that is not fiscally transparent. Foreign trust is a country X trust. Under the trust instrument, the trustee of the trust has the discretion to pay out income to its beneficiaries or to withhold and accumulate that income. And under the laws of country X, the beneficiaries are not taxed on the income of the trust until distributions are made. Foreign trust is not considered fiscally transparent. This is the end of part 1 of this lecture. Please continue with part 2.